Let's start with the dot plot. What are you looking for specifically in the dot plot through the end of this year into next year and beyond?
Yeah, well, thanks for having me, Jonathan. I mean, I would characterize the changes as mounting misery for the Federal Reserve. Of course, I'm referencing the Arthur Oaken index from the 1960s, where he added unemployment and inflation together. I would say overall, for the median path for the interest rate hikes, we think that you're probably going to see some big upward revisions, as you suggested. I think 75 basis points addition we could see for the end of this year. So that would imply, kind of 4 to 4.25 on the Fed funds, for the Fed funds rate. And then next year as well, we'll also see some upward revisions. So similar sized upward revisions that get the median path closer to 4.5. So that implies, some pulling forward of rate hikes as well as raising the terminal rate. And outside of that, I think this is going to be coupled with revisions to the economic outlook that are worse for growth, higher for unemployment, and of course higher for inflation. So again, this is really mounting misery for the Fed. I think they really understand that they are solely focused on inflation. They need to get the real Fed funds rate, which is what really matters, above neutral levels, and that's going to result in additional rate hikes.
Well, let's talk about where the pain lies in the labour market. Unemployment, their forecast, as you know, Tiffany, and I'll share this with our audience, 3.7% is the forecast year end, 3.9 23, 4.1 2024. At 2 p.m. Eastern time, Tiffany, what do you think those numbers are going to look like?
Yeah, I mean, I think the unemployment rate is going to move higher. So I think the question is what does their longer-term unemployment rate forecast do as well? So we think that could move higher. I don't want to get too wonky, but I think there are reasons to believe that there's higher search frictions in the labor market, which just means that that kind of underlying level of unemployment that's more neutral will also rise. That Federal Reserve has that at 4% now. Their estimates, the San Francisco Fed put the estimate of that closer to 6%. So it just suggests that the unemployment rate rise needed to bring down inflation is much more than maybe what is currently penciled into the SEP. So unemployment rate rise in terms of their forecasts, could be to 4.5 or maybe even a little bit higher. In addition, that could be, you could also see that longer run unemployment rate tick up as well.
Well, Tiffany, where do you think Nauru is? How do we know anyway? But what do you think it is?
Yeah, I mean, it's obviously very uncertain, and it's easier to estimate the past relative to what it is now. We had obviously a very big economic shock with the pandemic. I think there has been some reallocation to the economy as a result of that and to the workforce, and it is creating additional surge frictions. I would not be surprised if we see that 5% is more consistent with the underlying neutral level of unemployment. But of course, as I mentioned, the Federal Reserve Bank of San Francisco recently put out a paper that suggested it could even be as high as 6%. So that's well above where we are right now in the labor market, suggesting that is still very tight. And the Fed has a lot of work to do to really cool the economy off here.
So higher Nauru and then ultimately higher terminal to really do something about unemployment and to get inflation down. I asked this of Luke Carr a little bit earlier, Tiffany. I'd love your view on it as well. Do we have to rethink about the time frame that's going to be needed here to get inflation back to target?
Yeah, I think you do. That's a really good point. So certainly, I think you're going to get upward revisions to inflation, particularly core inflation. But these aren't necessarily upward revisions for this year. I think their forecast for this year looks okay, but what to me looks increasingly too low is the forecast for core PCE inflation in 2023 and maybe even out to 2024. I would argue that since the June SEP round, inflation is just looking much stickier, and that's not only looking at just how inflation has evolved, CPI or PCE, but it's also looking at a range of the surveys for longer-term inflation expectations. Most notably, the survey of professional forecasters that the Philly Fed puts out. They've been ticking up, and that's notable because that survey tends to have very low volatility. Professional forecasters usually think inflation is just going to be right at the central bank target of 2%. That's been ticking up, which is very concerning. And I would also just say that this broadening in inflation is not just a U.S. phenomenon. It's happening in other developed markets as well. And of course, just the last point here is that wage inflation has also accelerated. And the Atlanta Fed measure, for example, it looks more consistent with nonlinear effects in the Phillips curve, so that you could see wage inflation even rising more from here. And all of these trends, I would say, the Fed is probably not happy with.
So how much lower do you think growth needs to be then to achieve all of the above?
Yeah, so ultimately, we don't think the Fed will be forecasting a recession, but we think it's increasingly likely that you probably do need some contraction in real GDP to really get the unemployment rate up to a level that's more consistent with inflation falling down. I guess the question in terms of recession in the U.S. is how deep. I think some contraction is likely. The depth of the contraction needed, though, is we still think it's relatively shallow because we don't see a lot of economic imbalances when we look across the economy. Consumer balance sheets on average are still pretty strong, but nevertheless, I think it's becoming more clear that you do need some contraction in the economy in order to get inflation back down.
And Tiffany, short and shallow is the consensus. You lent on shallow. What about short?
No, so we actually think that it's going to be a more prolonged period of contraction relative to what you've seen recently. When I say recently, I mean the pandemic. So we saw this very V-shaped recovery after a very deep recession, the pandemic, and that V-shaped recovery was because of the policy reaction to the weakness. So obviously a very big fiscal response, very big response from the Federal Reserve as well. Because inflation is running so high these days, you're not going to see that type of fiscal response or monetary policy response. We think the Fed is going to be much more delayed in sort of accommodating weakness. So that just means that you get shallow but potentially a longer period of contraction, and even after that contraction stops, we would argue you're probably going to see a more prolonged period of just very sluggish below trend growth that's going to come about. So this is not more akin to something like an L relative to a V.